I've often wondered that despite running our printing presses non-stop for 24 hours, many of us still have cash flow problems and at the end of the month do not make the expected profits. Yes, the markets are competitive. Print buyers are driving prices down. But also, could there be another reason? Are we costing our jobs correctly? For instance, we all know that make ready is the time taken to set the job on the press. Yet, many of us charge make ready on a per plate basis. Does that mean if Technova reduces the plate cost, the make ready time will come down? Another example, we charge printing on a per thousand impression basis. Do we know what constitutes this rate? Are all our costs of running our presses covered in this per thousand impression rate? Is this number a cost or a price? To demystify all of this, I have pleasure in introducing Andy King, who will be talking to us on hourly costs, a mindset change. Andy is the Joint Managing Director of Shuttleworth Business Systems. Having worked for a leading paper supplier in the UK and graduated from college, Andy joined Shuttleworth in 1988 and was able to bring his knowledge of printing industry and his business qualifications to help printers seize the opportunity to improve their business through print management systems. He first recognized the need for MIS within the printing industry within the Indian printing industry in 2004, and since then has tirelessly worked to promote the use of MIS in India. So ladies and gentlemen, I present to you my business partner, my golfing partner, whom hopefully I should beat one day in a game of golf, Andy King. Thank you.
You can hear me, I hope. Thank you very much. Well, what a couple of great warm-up acts I've had so far. I wasn't expecting that. That was fantastic. Thank you for the welcome and the opportunity to talk to you about the importance of costing within the modern printing business. I hope it proves a worthwhile hour for us all. Just get used to the technology here. Okay, there's a saying in the UK, and there's probably an Indian version of this as well, that's turnover for vanity, profit for sanity. And what I mean by that is that we're all very, very proud of our turnover figures, and we talk about them a lot when we're talking to our friends and what have you in business. But it's profit that pays the bills. And after the earlier speakers, I had to add the word eventually to that little statement. But it's profit that pays the bills. And hopefully by the end of the session, you'll understand where I'm coming from with all that. Okay. If profit is for sanity, then it pays for me to define quite clearly what profit is. And it might seem obvious, but it's the difference between the sales revenue and the total cost of production. And it's the identification of the total cost of production that I'm going to focus on this morning. Now, over the last 4 or 5 years, as Bimal said, I've been coming to India since 2004. Over the last, in that period, I've spent a lot of time discussing, meeting with Indian printers, and I've put together a little summary about how I see the Indian printing company as it stands today. And the vast majority, as Bimal said in his introduction, of Indian printers that I've met, base their business, their quoting and so forth, around the price per thousand model. The question I should ask is, how many of you here today, when you're estimating jobs, base your your prices on a price per 1,000 impressions, price per 1,000 pieces, or so, something of that nature. Not everybody, because some of them use management information systems which don't do that, but a lot of people do. A lot of people do. Just working down some of the points here, the word cost, when we talk about cost, or when people talk to me about cost here in India, that is equal to the selling price, okay? And that selling price is made up of material cost, plus, as I say, the price per 1,000 impressions or pieces. And that's until you start negotiating, and then, of course, there is the discount that comes in, and so on. But there are a few questions that need to be asked. The first one is, do you know how much the paper costs? Well, you probably do. You probably do know how much the paper costs. Do you know how much ink or plates cost? Unfortunately, you can't see the answer to this, but you can see the smiley face. Oh, sorry, that's not a smiley face, that's a frowning face. And that is probably not. Do you know how much time the job is going to take? And the answer to that is probably not. Do you know how profitable it should be? And the answer again was probably not. And the question, is it worth doing, has to come to mind. When it comes to negotiation, and from my experience, that's in every deal that you do you know when to walk away? And the answer to that, again, is probably not, and there's a little image there of the ticking time bomb. Do you know how profitable it really was? Well, no, you won't. And was it worth doing? Probably not. So there are lots of issues and problems associated with pricing per 1,000. And I have to ask, why did I put in all those unhappy faces? Well, with a price per 1,000, the real cost price is unknown, and you have no control of your business. So, whilst it's true that you've got no control over your business, you don't know what it's doing, you don't know where it's going. Now, earlier I said that to be profitable, you had to recover all the costs of production. And that's both the direct costs, such as plates, paper, ink, outwork, and so forth. But you've also got to recover the overhead costs of your business with each job. And the overheads will vary from business to business, depending on the business's structure and the goals of that business. But will include some or all of the following. So, for example, we've got building cost overhead, where you've got rent, you've got lighting, water, power, the factory and offices costs. You've got production overhead, and so you've got the production incidentals, such as blankets, rags, chemicals, but you've also got the costs of the supervisors on the shop floor, the managers, perhaps even canteen costs and so forth, and balance sheets, the books of accounts or the chart of accounts, whichever terminology you use. The profit and loss will tell you whether you've recovered all of these direct costs and the overheads, but how often do you look at your profit and loss report? Now, some people do it annually, some people do it quarterly, some people do it monthly. A quick show of hands, how many of you get your accounts reported to you on a monthly basis, your profit and loss report on a monthly basis? So that's about a quarter to a third, I would say, on that front. Okay? And it's always interesting when that question is asked, because for even those of you that get your accounts monthly, there's always a lag between actually the month being performed and the reports coming in. So there will always be a period where you're sort of lagging behind and you don't have perhaps the necessary understanding of where your business has been in the previous period, or indeed where it's going. So what is costing and why will it improve the business? Well, I've summarized here that there are two types of costing that are prevalent within the printing industry around the world. The first is known as absorbed costing. The second is marginal costing. And both of these two methods of analysis are powerful tools. Okay? I've spoken to many people over the years who think you can only use one methodology or the other, but I disagree with that. I've seen many companies that use both of those together to complement each other. But they each work in a different way, and I'll explain how these things work shortly. But basically, they're used for people to look at their business, use both tools together, and help them to drive their businesses forward. Now, whilst the two methods of costing, they do share some common principles. Firstly, they both rely on accurate identification of direct costs. And by direct costs, we're talking about, as I said earlier, paper and board. We're talking about plates, inks, boxes, other consumable items. We're talking about outwork. But then we're also looking at the time taken for production. Okay? They both bring meaning in their own ways to the actual cost and time of production. If we look first of all at absorbed costing, as the name suggests, what this method does is absorbs all of the costs of running a business down to each hour of production for each machine. Now, to reach a position where you can practice this method, you'll need to identify the costs of all the non-directly recovered overheads of your business. The examples I mentioned earlier of building, production, administration overheads are what you would calculate. Now, having identified them, all the overheads, you then need to apportion them to each resource that you have within the business. Okay? Each resource that could possibly work on a job. You then calculate the production capacity for each resource. That will then produce an hourly rate, an hourly cost, or an hourly rate per resource. And as I said earlier, what you do need to do is you need to understand a resource's performance. You can't just assume certain characteristics, and I'll explain that in a moment or two. Now, there's no hard and fast rule about how this is done in terms of apportioning the overhead, but there's a couple of different ways that you could use as examples. As I say, it's not written in stone here. The first would be perhaps to look at how much space a machine takes up within the factory, and then apportion the overheads accordingly. So if a machine takes up 25% of the space within the factory, you'll apportion 25% of the overheads to that machine. And when you're looking at the hourly rate for that machine, obviously you'll include its direct costs in there as well. Another option that I've seen is where the apportionment is done on the value of the resource. So if a machine has an asset value of 20% of the total production assets, then it would have apportioned to it 1/5 of the business's overheads, as well as its identifiable direct costs. As I say, there's no hard and fast rule. What you do need to be, though, if you're going to adopt this methodology, is you need to be uniform and consistent across all of your machines and resources. That's the key, really. Now, what I've created here is a spreadsheet to give you some examples as to how you could calculate an hourly rate and some of the interesting facts that come off the back of that. Now, for that, I'm going to have to hit this button here, and it should. That's not great, is it? Just to explain, what I've done here is I've created a spreadsheet which breaks down the costs and shows how they can be apportioned on an absorbed basis. So there's a couple of things that we've got at the top of the sheet that are crucial to this. Basically, we've got some variables, and what we're saying here is the number of working days in a month we're saying is 24, and the number of working hours in a day is 16. With that information, we can then start to break down the cost to an hourly rate. And the way we get there is, first of all, looking at a new machine here. We've got the cost of equipment. So the cost of equipment we're saying is 3.4 5 crores. And then we've got depreciation against it. We've got the total figures there, the subtotals. We've got the total area that that machine takes up, and we've got its rent, we've got its direct associated costs there, fixed costs. We've then got insurance costs. So we have a rate for the figure showing down here. If I come down, we'll break it down here. We've got the total fixed costs expressed as a total there, 2,159.83. We then look at the power. So we've got our power costs. We've then got our maintenance costs. We've got our consumable costs. We've got all of our non-production overheads. So in there we've got non-production staff, power and lighting, vehicles, all of these things. All the elements of cost that are incorporated within our business, we've identified looking at the machines. We've then got our operators' costs. We've got our total labor cost, total machine costs down here. So basically what it said is the total cost of running that machine per hour, based on the figures that we had at the top, 3,002 rupees. We've got a contingency cost there to give us a total per hour cost of 3,603. We're saying that this machine is efficient 100% of the time, which is, I know it's not true, but I want to show something with this in a moment or two, where the final cost per hour is 3,603. If we then want to work it back to show you a sort of a figure that you're familiar with, a cost per hour, what that's saying is we can produce at a rate of 5,000 per hour off that machine. So the rate per 1,000 impressions per colour is 180 rupees. We've then got ink figures, which I've factored in, to give us another 32 rupees per 1,000 impressions. So the total cost, absorbed cost of running that machine is shown here at 212.15. Now, I have to stress that that is a cost figure. It is not a price. This is a cost. We're trying to look at the costs of running our business. Now, if I go back to my options up here, I just want to change the appearance of the screen a second, because I want to include now a second-hand machine. Now, there'll be lots of people here in the audience that have got a mixture of different age machines, new machines, second-hand machines, and we're looking here at a second-hand machine, which on the face of it is a cheaper machine to buy. So we're talking about two crores there to buy. We've got all the figures there, the same figures in terms of the percentages and so forth. It's taking up the same total area. So we've got a fixed cost, which is less to run the second-hand machine than it is the new machine. We've then got power costs, and I've kept some uniformity in there. We've got maintenance costs, although as somebody had pointed out to me, we've got a lower figure here. It might be actually more expensive to maintain a second-hand machine than it might do a new one. We've got then the consumable costs, which are more or less the same as the new machine. We've got a summary of the figures, and we can see here, in the summary, the total per hour cost is less. It's 2,737.85 rupees. Now, what we've also done is we've said that machine, we wouldn't expect that machine to be operating 100% of the time. It's very rare that would actually ever happen. So we've got a figure down there at the bottom where we've said we're only going to operate this machine 90% of the time, giving us a fixed cost per hour of 3042.06. Now, when we start to factor that cost against the machine's performance, what we can see is that machine doesn't produce at the same rate. The second-hand machine doesn't produce at the same rate as the new one. So we're actually producing less, but we're recovering. We still have to recover the cost. So because we produce at a lower speed, our actual rate per 1,000 impressions is higher. And when we factor in the ink, based on the same figures as for the new machine, we can see that the total cost for 1,000 impressions on the new machine is 212.15, but on the second-hand machine, even though it's a cheaper machine, the actual cost that we need to recover for that machine, because of its performance and because of its lack of efficiency, we're not using it all the time, every hour that we do use it, we need to recover 275 0.36 rupees. Now, I've done the maths, and you can see it's confirmed here. The difference in this example is a figure of about 30%. So we need to recover 30% more cost for a second-hand machine than we would for a new one. If I go back to the top of the spreadsheet, I mentioned earlier on, we've got these figures here, where we've got the variables. Now, I can sit and fiddle about with these variables for quite some time, but I just want to show you the impact that these have on the final calculation. If we decide we're going to up our working practice from from 16 hours a day to 24, make that change, and the bottom line figures, you can see, when we make that change, the bottom line figures come down, because we've got the same amount of cost that we need to apportion, but we're actually working more hours, we're being more productive, so our cost per 1,000 impressions comes down to 159 from 201 if we work more hours in the day. Now, obviously, again, you'd have to adjust your figures because there'll be some extra costs in terms of operating for 24-hour shifts. But again, if we just go back and change the number of working days in a month, if you have a short month, or you decide, for whatever reason, working practices change, you change the figure there, that's one small change on the spreadsheet, but because we're working fewer hours in the month, we'd actually have to recover more money with each hour that we do work. So it's fairly straightforward maths that we have here, but any small change that we make to our overhead base, our cost base, should be reflected in the hourly rate that we have for our machines. So, there's a few points to note there. It's important when you're adopting absorb pricing, absorb costing, that you compare your budgeted hours to the hours that you actually work. There's no point in basing your budgets on 16 hours a day when you're actually only working 12 hours a day. Okay, or only able to charge for 12 hours a day. And if you work more hours, more charged hours in the month, then in effect your hourly rate would come down. If you work fewer hours than you budgeted, then that should increase your hourly rate. Any change, as we saw earlier on, any change in overhead costs will affect the hourly rate. And this particular example that I showed you assumes some consistencies within production. And therefore across factors, but that's not always the case. For example, some types of cost, it's safe to have consistency, but others, for example, ink usage and machine performance are not consistent across every single job that you do. They differ from job to job, which is one of the big shortcomings with the price per thousand method. Just put a little notice there. Unfortunately, I say technology is not allowing me, but where it says where identification of actual cost is possible, then there's a big thing underneath that says do it. So you really should be identifying the actual costs wherever you can within any type of work that you do. So why is a price per thousand, why can it be dangerous for your business? Well, as I said earlier, it assumes consistency of production, which just doesn't happen. Papers run at different speeds. Different types of paper use different amounts of ink for seemingly the same image. It's also very difficult to compare your estimated costs against your actual costs when you're basing your estimate on a price per thousand, because the actuals are going to come in time. So you're not comparing like for like. You need times to be able to compare against the budget. You also need consumption figures of the actual amount of materials that you've used. Now, I have another example here. An example of two jobs, both basically the same job, but with a slight difference. The slight difference being the weight of the material that we're printing. So we're printing both onto an art paper, a glossy paper, but one's a 130 gram and one's a 300 gram. Okay. Now I've put some figures into the spreadsheet here, and if I just marginally adjust them.
Can I enlarge it for you, please? Can I enlarge it for you? Just change the top on the top, this size of.
We've got the 130 gram, and we're saying here the price for the material is $4,950. We've got the 300 gram where we're saying the price for that material is $11,440. Now, under any price per thousand model that I've seen, that price would be picked up. That price differential will be picked up within your estimating. When we look at the rest of our job, it's quite a simple job, but I'm just using it to make some examples here. The plate cost is going to be the same, so there's no difference there. On the press, the make ready will be the same, the plate change will be the same, all the same times, all the same costs. But when it comes to running the 130 gram, a 130 gram will run quicker than a 300 gram. Okay? And what I'm saying in this example, the 130 takes 5,000 an hour, but the 300 gram we run at 2,500 an hour. So we've got twice as long to run the 300 gram as we have the 130. When it comes to things like cutting, which again normally is done on a price per 1,000 pieces, in terms of cutting, because of the nature of the thicker board, we can only cut a limited number, a lesser number with each guillotine cut. So basically that's going to take 2.5 times longer. So what we've got are 3 areas of difference on the actual cost of doing that job. The first one is the paper cost difference. We've got the running cost difference and then the guillotine cost difference. And when we add all those up, the total difference is 7,948. So that's the total difference in terms of the difference between running the 300 gram and running the 130. It would be my suggestion that if you were running or calculating based on a price per 1,000 copies, what it would have, you would only pick up the price difference. So you'd be losing out on a figure there of 1,456.50. So you're actually going to be potentially losing that opportunity to recover 1,456 rupees in this particular example. So if your business has a variety of different, if you're producing the same thing all the time, there wouldn't really be a major issue with that. But because most printers will produce jobs on different types of material, they produce jobs, different weights of material, different coatings, they're using different ink amounts, they're using machines that run at different speeds for the different weights of material and so forth. If your business is the typical printing business, then those two elements you need to be looking at your absorbed cost of production. Otherwise, you're in danger of missing out on the opportunity to recover more cost. Now, I said earlier on there were 2 different approaches to costing. We've got the absorbed costing. We've then got marginal costing. Some people might have heard of this as value added. Is anyone familiar with that term, value added? Yep. Okay. Basically, what this does is it shows the difference between the selling price and the direct costs that you're going to be paying out on that job. So the paper costs, the direct consumables, plates and ink and so on, and any outwork that goes with it. And then the difference between the two is the gross profit or the value added. Now, the way that this works is that all the jobs that you produce in a month all should generate some value added, and at the end of the month what you should be doing is you'll be looking at the total amount of value added that you've generated and comparing it against your overheads for running the business, and if you've generated more VA than overheads, you've made a profit. If you haven't, you've made a loss. Now, it's critical here that you don't just look at the value-added figure when you're analysing work, but you also need to see how quickly it is that you generate that money. And that's what's known as the value-added per hour. And that way you can actually compare the available hours in the month and see how you're performing as you go. Now, I've created a small example here with two different jobs. The first job, job A, 25,000 rupees. Second job, job B, 16,245 rupees. That's the turnover figure. So again, with the old adage of turnover for vanity, at the moment, job A is looking the better of the two jobs. But looking down, see how we've broken that down, you can see we've got the sales value, 25,000, 16,245. What I've then done is just summarize the costs, the direct costs, paper costs, consumables. In job A, the total there is 16,000 rupees. In job B, the total of that is 16,150. The market says we are able to get this amount for these jobs. So that's what the market is telling me. And what it then says is the difference for job A is I'm making 9,000 rupees towards my overhead recovery. And on job B, I'm making 10,095 rupees towards my overhead recovery. So it doesn't take a genius to work out that you'd rather have more job Bs than you would to have job As, okay? Now, value added does bring one area that absorbed costing isn't quite as good at, and that is it helps you when you're doing negotiation. Now, by that, what I mean basically, if the client turned around and said, actually, I'm only prepared to spend 15,000 rupees for both of those jobs, the first job, job A, will turn immediately into a true loss because you're having to shell out 16,000 rupees to your suppliers. So turning 16,000 into 15,000 doesn't make good sense at all. Whereas if you took this job and said 15,000, you wouldn't be getting your 16,245, you'd be losing a little bit of that money, but you'd still be making a recovery of over 8,000, I think 8,850 rupees. So you might decide at 15,000 on job B, I'll take it, because you're still making a recovery, a contribution towards your overheads of, as I say, it would be about 8,150 rupees, 8,850 rupees. So you can use marginal costing to support absorbed costing. Absorbed costing will give you a guide as to where your overall costs are, but on a job-by-job basis, you may want to look at your added value and say, I'm prepared to go at a slightly reduced margin to get that job and make some recovery for overhead recovery for this particular period. So if monthly overheads are 15 lakh rupees, we'd need, in this example that I've just shown you there, we'd need 166 jobs like job A in order to break even, and that's 428 recoverable hours. But job B, we'd need 149 of those to break even, 381 hours need to be recovered. So basically we want more of job B than job A. Now, how are we doing for time? Okay. When you start to use this type of costing method, you're going to generate information. Now, how you bring that information into you and make use of it, obviously it's down to you as individuals. How you make use of that information is down to you. Using a management information system can help you in as much as it will generate an awful lot of reports off the back of that base data. And one of my clients' favorite reports is what we call the projected value added report. Now, I'm not going to show you an image of it, but basically what that does is at any point in the month, it can project forwards based on your value added, takes the value added for all the jobs that you've got in hand, it knows when they're going to be delivered and therefore when they're going to be invoiced, and it can project quite accurately where you're going to be at the end of the month. So we're sitting here on the 24th of the month. My clients will know where their business will be in terms of their overhead recovery due the 28th of February. And in some cases, if you've got longer lead times, you might be looking through to March and seeing how your business is going to perform in March. You're able to look forwards rather than wait until the monthly profit and loss has been reported to those of you that report the profit and loss. What you can do with the information as well, it can guide you in your pricing decisions. The value added helps you look and see which of the jobs are the most profitable, and in effect, if you're making good recovery this month, don't unnecessarily reduce your prices. If you've not broken even yet, what you can then do is identify the jobs that have got the biggest value added and go after those to try and recover the overheads that you need to within the business. So you can go after them in that respect. Now, the information that you generate helps you to know where you are. How many of you have got GPS, either on your smartphones or on other devices? iPads have them, and I've seen a couple of those this morning. Smartphones have got them, cars will have them. GPS enables you to see where you are and helps you to plan where you're going. And I sort of compare a good costing system to a GPS for your business. It tells you where you are, it indicates where you're going to go, and gives you some clues as to how you might want to get there. Now, just finish off. I think now's the time to summarize. First things first, cost is not the same as sales value. That's important for me to stress. The sales value is generally determined by the market. Understanding your costs helps you to understand your business. Understanding that will lead to improvement of your business. You can control the improvement. You recognize the subtle differences within the business. You can maximize the opportunities. If you know where your business is, as far as overhead recovery status is concerned, what you can then do is you can attack the opportunities in the market. And finally, you can use costing to help build yourself a better business. Now, I'm going to apologize for the slight technical problems that we've had, but apart from that apology, that's me finished. I'd like to thank you all very much for your kind attention.
Any questions?
Now that you know that our overall cost is 112 and plus and all, how do we actually charge our customers for that?
Well, it's a very good question. The thing is, what you need to make sure is you need to understand what your cost rate is. If the market says, and it's the market that will determine the price, not you. The market tells you what the price will be. If the market price is 200, in effect the equivalent of 250 rupees an hour, then that's fine, you can sell at that price. If the market price is 200 rupees an hour, you know that you're not actually recovering all your costs at that rate. And you can still make the decision to sell it at 200 rupees an hour, okay? But you should know that you're not actually going to be generating the type of return that your business needs to recover all the overheads and turn in a profit.
I have a very fundamental question. I think the marginal costing system is very clear. I mean, it's all direct materials, out-of-pocket expenses, so that there is no kind of dispute on that. The problem comes when you look at overhead, because overhead does not get absorbed, all overhead categories don't get absorbed on machine hour basis. So the question is that how do you take into account overhead absorption if everything cannot be brought to machine hour?
Well-
And the absence of a good overhead costing system, what do you do?
Well, the question would be, why can't you bring the overhead down into an hourly rate? There's no rule that says you can't do that.
Well,
That's the whole principle of absorption costing. You look at all of the overheads, well, whatever they are, and you then burn them down to a figure.
yeah, we are assuming that cost like management and supervisory cost is based on machine hour. There could be various categories of cost, nothing to do with machine hour.
Yeah, but
Like
that's-
management time, sales, administration, those are nothing to do with machine hour.
Exactly. They're nothing to do with machine hour directly, but they are overhead costs of running the business.
Correct.
And they need to be identified and then apportioned to the machine on whatever form, as I said earlier on about whether it's a space form or a cost of the asset form. Some way we need to identify all these overheads and then build them into an hourly rate, which is then attached to the other direct costs of running that machine, those that are directly to the machine, to construct the absorbed hourly rate. So the one thing you are doing with an absorbed rate is you're looking at the entire business, not just the operation of that particular resource, but the entire business and associating the overhead costs down to a machine hour.
So you'll take, would you take the printing machine, the die cutting machine individually on machine hour? How would you absorb pooled overheads for the plant, pooled overheads for sales and administration down to different machines within the plant? Because you have printing, you have cutting, you have finishing machines.
As I say, there is no hard and fast rule.
All right.
One of the organisations in the UK, the BPIF, what they used to work out was based on space. So how much space in a factory each machine took. So if you've got, as I said earlier, with a machine with a quarter of the space of the factory, then it will take a quarter of the cost of sales, a quarter of the cost of the admin staff, a quarter of the cost of the lighting and heating in the sales office, and all that sort of stuff would be apportioned down. A quarter of it would be given to a machine. The machine hour, how many hours in the year that machine works, would then be divided into that figure to give you the hourly rate.
Thank you.
Okay, thank you.
Thank you, Andy. I call upon Hemant Botika to facilitate Andy.
Thank you very much.